In this video, you'll be learning about this topic.
So one of the things that you and I talk about a lot online is gold and Bitcoin. I mean, the price in Bitcoin has just been explosive in 2020. When you look at gold, it was explosive as well, but then it's fizzled out here in the third, going into the fourth quarter, when Bitcoin has really started to perform. I mean, it's been the strongest part of the move in 2020. When you and I have some engagements online, you talk about gold having this levered derivative kind of explosive piece to it potentially if it gets to a certain point. Explain this to the listener. And I'm more interested in just kind of hearing your general thoughts about both of these two forms of holding value.
I like them both a lot. So the gold market was allowed to expand in a lot of different ways. Cash settled futures are a small part of the problem. When you have a cash settled futures contract, it means you don't have to have the gold. You can settle in cash. Most of them are settled in cash. But once you're settling something with a high stock to flow ratio like gold in cash, the high stock to flow ratio means you can separate physical fundamentals, supply demand fundamentals from the price for a very long period of time, which means the cash settlement aspect of it turns it into a balance sheet contest. And so I think gold supplies are being bought and they're getting very tight. And so I'm going to own some gold futures. And that might very well be right. But if JP Morgan's trading desk comes in with $2 billion notional for sale, or whoever that is that comes in the middle of the night, it doesn't matter. Your stops get run, you create this waterfall effect, right? And so that's a short-term type of aspect in terms of the futures. The bigger deal, in my view, and as I had it explained to me, is the unallocated gold market out of London, or the credit gold market out of London, where it's, hey, I want to own $100 million worth of gold. Done. And it's not like they found the gold, produced the gold, right? So contrast that with what Michael Saylor is on the tape saying what he had to do to buy his 400 million in Bitcoin. It was like a Navy SEAL raid in terms of trading to make sure he didn't squeeze the price up. And the difference in that amount of liquidity is this credit gold market. And so when I say ultimately the credit gold market can go on and on and on as long as there are no leverage restrictions in terms of that. There's always been sort of this mythical or conceptual, maybe the better way to put it. Something could break that market or force an unwind in that market. They would have to be big. They would have to probably have nukes because gold is not a free market. It has never been a free market. It is a political metal. And that is, I don't think, fully appreciated by everybody. But in theory, if that happened, then the deleveraging of that system would have to be settled via price. And, the COMEX guys, when they said, hey, we've got 1 or 3% in the vaults, they took Kyle Bass. Kyle Bass talked about it maybe 3, 5, 7 years ago when he owned some gold for the Texas University system, et cetera. But he went on the vault tour at COMEX and he said, well, what happens if, you guys are 3% reserve? What would happen if someone came in and said, I want it all? And he said, oh, that never happens, Kyle. I was like, but what would happen? Price would settle everything. And that's the point. Now, it's a political metal. The Hunt brothers tried to do that and they just shut down the exchange, went sales only and squeezed them out and they lost big. Any average size hedge fund could go into the COMEX and clean it out today. There's a reason why they don't. I don't fully know why they don't, but I've got my suspicions. It's a political metal. It's not a pure market.
And so in summary, you're saying that if you really wanted to take it home, it might be an issue. Even if it was a fractional reserve situation, I would have to bid the price. However, in that situation, the prices globally play into a factor of what's happening locally.
Well, it would have to be some sort of structural event, right? It would have to be, the one I've used a lot because I think it's maybe the cleanest way you could see it happen. So things get chippy with the US and Russia and China. And Russia and China get together with Saudi and say, we are only accepting physical gold for our oil at a value of 1,000 barrels of oil per ounce. And immediately everyone in America in the paper market is going, oh my God, what a great arbitrage opportunity. I'm going to go buy an ounce of paper gold and I'm going to turn around and get 1,000 barrels of oil, and then I'll turn around and sell the 1,000 barrels of oil, and it'll be worth $40,000. And everyone will show up at the paper markets, which will promptly close. You'll be cash settled at the prior day's close, and it'll be physical only. And so your paper you'll get paid in your paper, but unless you own the physical, that's how you could break that. That's the type of thing that it would have to happen.
So let's say we fast forward into August of 2021. And let's just say, for critical thinking drill here, the price of Bitcoin is punching through 100,000 in August 2021. Does this narrative start to run on Wall Street and cause concern as to the utility of gold being a store of value? Is this something that the people that own gold start trying to actually sell it in order to start buying Bitcoin? Or do you see that these are just two totally different worlds?
I think it depends on the level you are. I think if you're the average millionaire, you're the average, 10 millionaire, yeah, you probably sell some gold. Maybe you get real aggressive, sell all your gold. The market's telling me this. If you are a giant, right? If you are Russia, if you're Saudi, the Russians are not going to dump their gold to buy Bitcoin.
Yeah, I completely agree with you. I don't think that would ever happen. If they wanted to buy Bitcoin, would they then just print more money?
They could conceivably. And as it is, I think they've banned it. I think it's illegal. Not that that's worked per se for them or the currency, but I think I saw they were looking at making it illegal. Not that that's, I think, the right thing to do or a risk. But the point is, I think the super giants in the system, and I tweeted about this today, at some point, if Bitcoin's punching through these bigger and bigger levels, you're starting to talk about this sort of institutional threat. You are disintermediating the banking system. What do you need a central bank for? If Bitcoin's $1 million a coin, $1 billion a coin, who needs a central bank? And that's where I think the higher it goes, at some point, I think there starts to be some institutional pressure for these guys to defend their franchise. All right, what do we have on our balance sheet that can compete with Bitcoin? Well, look around, guys. We've got mortgages for mom and pop in, Poughkeepsie and, gold. Okay, let's raise the price of that. There's things they can do there. Now, this is, to be clear, this is speculative on my part. It's based on a view that if Bitcoin does what I think it could do, as to what you're hypothesizing it could do, which I think is entirely possible, what the stock to flow charts and what have you that are out there suggest it could do. To me, the wild cards in it are that don't get as much airplay that I'm trying to raise is, what do the super giants, so to speak, and that's a term from FOFOA, what do the super giants in the system, in the status quo, do they just sit there and watch that whole central banking fiat seigniorage franchise just get taken away? Like, Amazon did to Walmart and Walmart may be a bad example, but the entire, a lot of these brick and mortar stores? Or do they say, what are we going to use to defend our franchise? What are we going to do? And there's only one thing on their books they can use to defend that franchise that has unlimited upside in price, and that's gold. And they have a printing press. So in theory, they could come out and say, Bitcoin's $1 million. Okay, gold's 100,000. We'll make a market right there. I don't think that's going to happen, but I'm just saying conceptually it could. And I'm just thinking in terms of the institutional motivations as Bitcoin continues to be more and more successful and really sort of stick their nose in it, right? I mean, I had a drink with one of the biggest physical gold traders in the world 3 years ago. So it had been like August of 17. We were in New York City, and Bitcoin was doing sort of its first. It wasn't really getting to the heights of that year yet, but it was starting to really ramp up. And unsolicited, we're talking. He goes, you know what, Bitcoin's doing what gold would be doing if it didn't have all this giant paper market attached to it. And that was exactly what I thought of it. Because I do agree the stock to flow dynamics in terms of the happenings and the supply, they're superior Bitcoin versus gold. They are, because you do have the mine supply increases. I disagree with Saylor's 2% number. I don't think that's the right number. Gold supplies haven't risen for a couple of years, actually. And at current prices, I think his supply numbers are overstated. But to his point, they are generally positive over time. And unlike Bitcoin, they're price sensitive, right? So if we woke up tomorrow and gold's 5,000, those supply numbers are going to adjust accordingly, et cetera. So I think he makes a very valid point. But I think the price response could be very nonlinear and in gold. And I think I said that to you today, where I think there are periods of time where gold could outperform. And I think those periods of time are probably going to be very compressed and probably around political events or just the system being, Bitcoin doing so well that it starts to sort of threaten these guys, their franchise.
Thanks for watching. Make sure to subscribe and hit that notification bell so you don't miss out on the next podcast episode and new investing resources.
What are your takeaways and thoughts on this discussion? Let us know in the comments section below.